You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Well, before we get too far along, I should let you know that we are taping Options Playbook Radio with the market opened. It is Wednesday, May 18th. A lot of times we usually tape after the market close. We're taping a little bit early today. And the markets are rocking and rolling. We've had some very interesting earnings reports in the discretionary sector, with Walmart announcing earnings yesterday and just getting cremated and brought down Target. And guess what? Then Target announced this morning, and they're even getting more cremated. So not only were they down, was Target down yesterday because of Walmart's earnings, they piled on today because Target disappointed. Everybody's saying supply chains concerns, inflation. Nobody in the retail space seems to be able to handle what's going on with the supply chain. Should we stock up? Should we not? Where are the inflationary issues at? The only retail stores that are doing fairly well are the ones that cater to the upper class, where basically interest rates and that do not matter because they're paying for cash for most of their little widgets that they are buying. So Target, Walmart have really thrown a twist into the marketplace. So we do see the marketplace down at this point in time. And I'm going to use a word here. The word is befuddling. I'm not really sure what to trade in the marketplace. And one of the things that also surprises me is just flat out the Vix Index. Talked about it a few times here on Options Playbook Radio. Not that long ago, we saw the VIX actually trading down around the 20% level. And I definitely felt like at that point in time that the VIX needed to be higher. Didn't really understand why it was trading at that level. And I think I even mentioned it on an Options Playbook Radio. On April 21st, it was down right on the 200-day moving average, actually, was right at 21 on that day. It traded through that level, closed a little bit higher overall. Then we actually had the big spike up, and we eventually got up to about the 35% level. And now, once again, we have a down day, and we're seeing the VIX trading right around the 28 level on the actual spot. Okay, so another thing that I find interesting is that if I look at the VIX of the VIX, the VVIX index, which tracks the implied volatility of the options of the option chains inside the VIX index, and we see that trading down on the lower end of the range. And right now we have that trading right around the 104 level. So That's the lower end of the range for the VVIX. So we have the VIX trading around 28, a little bit higher implied volatility, or at least relative to the 200-day moving average. And then we have the VVIX trading at the lower end of the range. So I'm going to do a trade in the VIX, and it's quite simply because I'm not really sure where I want to trade. We have talked about a couple of the sectors that we thought would do well in a rising interest rate environment, and we looked at the energy sector. We also talked about the financials, which has been mixed, bluntly, and that's mainly because of the interest rate curve. The difference between like the 10-year and the 2-year hasn't really expanded at all. And that is a sign of a recessionary. It's one of the telltale signs, especially if you see the 2-year yield trading higher than the 10-year yield on the curve. That's not a good thing. That's usually a sign of a recession. We're not there yet. We were there for just a second. But at this point in time, we still see the 10-year yield trading below 3%. Right now it's at 2.917% is according to the TNX index, the CBOE interest rate index. So we're keeping below 3, even though the environment, the Fed is saying that they're going to be raising interest rates as they go into the next couple of meetings. And so once again, markets just befuddling. So one of the things that we see right now, the SPX is trading at 4,005.98. All right, the markets are moving. I'm just going to take a screenshot of it. And I think that 4,000 level has been very important to the SPX, and it's kind of been a line in the sand. If we make a strong break below it, we did go below for a couple of days, and we bounced back up, and then we struggled. It looked like we're going to get a little bit of a bounce. But if we definitely go below that level and stay below it for, let's say, 5 or 6 trading sessions, that's going to be a bad sign for the marketplace. And I do think that the VIX around 28 needs to be higher. It's just that simple. I don't really understand it. So I have a question, and actually I want to toss this out to you, Options Insider. I think that this would be a great question. We've had this debate about long straddles, but buying premium versus selling premium. And I think as far as an analyst, I'm not 100% sure of this, but there aren't a lot of people on Options Insider Radio that have talked about long straddles. And I have done a few on Options Playbook Radio on my podcast because I think that there's a time for it. And right now with the SPX right around 4,000, I personally, with the VIX at 28, which I think is low, with the VVIX at 104, it's moving quickly. But with those scenarios, I really think if I was forced, if you said, okay, you either got to give up, you got to be right on this thing, or you're going to give up your 401k, your retirement, right? You got to pick either, are you going to buy the long straddle in the SPX, or are you going to sell the long straddle in the SPX? And let's call it 4,000. All right, let's call it the 4,000 level. If that is the case, I would be a buyer of the long straddle. I just really think that there's way more unknowns in this marketplace than there are knowns. And I think that the VIX is underpricing the fear in the marketplace and the unknowns. I was very surprised when we came down to the 4,000 level I'm going to say about a week back, and traded through that level, that we didn't see the VIX spike to the 40, 45, 50% level. I was very surprised to see that. And I would have liked to seen the VIX actually spike, because that would have gave me a little bit more confidence in the fact that we maybe are getting some capitulation in the marketplace, and maybe we're going to get a good solid bounce to the upside, but it didn't happen. And so here we hang right around 4,000. Marketplace is trying to decide, do we go below it? Do we not? And the VIX index is I'm just going to use the term again, befuddling to me. All right, so let's short a VIX. We're going to short a put spread. I thought about just buying premium outright because of everything that I've just said, but I just don't really feel confident in that in the VIX index. There's just always so much juice. Like I said, you see the VVIX trading right around 104, even though that's on the low end of volatility as far as the VVIX is concerned. It's still a lot of vol premium. So we're going to sell a short put spread because of that. We're going to go out to the June 1st expiration, 14 days approximately in the VIX Index, and that is a crazy amount of time as far as the VIX is concerned. So June 1st, it is the expiration we're going to choose. That's 14 days away. We got the actual VIX Index is at 2794, and the June future is trading at 28. And if we go up further in time and go up to September and October, we're seeing the VIX future almost trading at 30. The September futures contract is 29.75. The October is 29.70. You go all the way out to December, and we're a little bit low. We're still at 28.25, but it's still higher than where the actual spot is at right now. So the futures are trading basically flat relative to the spot index. So the one that we care about is the June 1st expiration. And with a screenshot of the market is trading right at 28%. We're going to go and sell the 25 strike put and then buy the 23 strike put. Right now, we see that trading at the midpoint of about 47 cents. It's a fairly wide market. I'm going to just make the math simple, and I'm going to give us 3 cents on that midpoint. I'm going to say it's trading for 50 cents. We're going to come back next week. We're going to talk about it. So if we got a really good fill based off of this screenshot I just took, we would be filled at 50 cents. Market's really at 47 cents, and it's a fairly efficient market in the VIX. So trading right at better than the midpoint is pretty tough to do. I'll just say that. Okay. But everything that we do here on Options Playbook Radio is not meant to be a recommendation. This is obviously a speculative trade, but we do talk about, real situations. And that's what Options Playbook Radio is all about. Is we have over 40 different plays inside the Options Playbook, and we want to try to come up with scenarios where you might use them. So this is a great example. I wouldn't mind buying premium in the VIX, buying calls, even out of the money calls in this scenario. But there's just too much juice in them. So I'd rather do a short put spread. So how else can we get bullish? We could be bullish and have unlimited upside potential by buying long calls, or we can just sell a put spread and do it more short term and hope that it expires worthless. That would be the ideal scenario. Don't have to pay any spreads if it expires worthless. So in this scenario, if I do it for 50 cents, it's 2 points wide. That means that I have $1.50 worth of risk. Now, I prefer to do 2-point wide spreads and get somewhere around 50 cents. And this is mainly because I want to be able to close out that trade. And if I can close it out for a dime or 15 cents, I'm going to do that. And if I went in and, for example, and say I sold a 2-point wide spread for 20 cents, well, then you're kind of confined to doing that trade and just hoping that the options go out worthless and you make the 20 cents, right? I would rather sell a 50-cent spread and buy it back at 30 cents than opposed to just do the 20-cent spread and just hope that I gain that the options go out worthless and I make that 20 cents that way. I would rather have something that I can trade and get out of. And one thing that's really tough, especially on the VIX index, is to try to capture that last 10 cents, to get that last 10 cents of decay in the VIX index, just because there is just so much juice in it. It's really hard to capture that last tidbit of your short put spreads. So here's the trade again. Give you a quick recap. We are going to be selling the June 1st expiration 25 strike put, and at the same time buying that same expiration 23 strike put. We're going to try to get this done for a net credit to the account of 50 cents. If we do this trade in 14 days, we hope the VIX is higher than 25. If we can close it out for around 10 or 15 cents, we're going to consider doing that. As a matter of fact, I might put in a good till canceled order to close it out at 10 cents just in case it happens in the short term, and I don't want to miss it. If it's going against me and I see that the market gets down to the 23 level on the actual VIX index, especially if we see it on the June futures contract, I'm going to look at that trade and probably close it out. On a lot of short spreads, I don't like it to come down beyond my long strike I want that to be an at-the-money option contract when I want to try to sell it. It's just, it's kind of the way I like to trade on it. At that point in time, who knows what you would be down, but you could say to yourself, well, I'm selling it for 50 cents. That's my max gain. If it's trading for $1, the maximum is $1.50, right, that the spread could trade for. But if it's trading for $1, I would lose 50 cents on that, and maybe I would close it out at that point in time. It's all about your risk parameters and how active you are in the marketplace. But that's the way that I would approach this trade is I would put the good till canceled order in to try to buy it back at a net debit to the account of 10 cents. If I saw the VIX or the VIX future trading around 23, I would consider closing out that trade and moving on to the next one. All right, well, that's it for this edition of Options Playbook Radio. If you have a question you'd like me to try to address on the show, last week we did a huddle, myself and Mark, and the questions are just so awesome. They're such great questions from this listening group. I love to come back and do them. Well, you can email them to me directly at theoptionsguy@invest.ally.com. We do a lot of things besides Options Playbook Radio for investors. If you'd like to learn more about them, follow me on Twitter. My handle is @BrianOverby. I always tweet about the events that we're doing here over at Ally Invest. And with that said, thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish into money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.